threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation.
I hate to do this right now, but I'm going to have a press call first thing, and I really don't know what I'm going to tell them.
The national debt is on pace to hit $50 trillion over the next 10 years.
Tell them Lehman exacerbated AIG. The simultaneous of CDOs and credit default swaps put catastrophic pressure.
Go back further.
The global pool of investment capital.
She has to do this in English.
I really don't understand why it has not done more damage already. I mean, you talk about 50 trillion. I mean, I remember when we're talking about 10 trillion. Trillions.
Start with the homeowners.
Okay, here's how you explain it. Wall Street started bundling home loans together, mortgage-backed securities.
Simply flooded the system with money.
Yes, we did.
And selling slices of those bundles to investors.
That's another way to think about it. We did.
Where does it come from? Do you just print it?
Just spending like we're on crack.
And they were making big money. So they started pushing the lenders, saying, come on, we need more loans.
The lenders had already given loans to borrowers with good credit, so they go bottom feeding. They lower their criteria.
Before, you needed a credit score of 620 and a down payment of 20%. Now they'll settle for 500, no money down.
We printed digitally. We as a central bank, we have the ability to create money digitally.
And the buyer, the regular guy on the street, assumes that the experts know what they're doing. He's saying to himself, if the bank's willing to loan me money, I must be able to afford it. So he reaches for the American dream. He buys that house.
The banks knew securities based on shitbag mortgages were risky.
You'll work on shitbag.
And we do that by buying treasury bills, securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve banks.
To control their downside, the banks started buying a kind of insurance. If mortgages default, insurance company pays. Default swap. The banks insure their potential losses to move the risk off their books so they can invest more, make more money.
Well, a lot of companies insured this stuff. One was dumb enough to take on an almost unbelievable amount of risk.
AIG.
And you'll work on dumb.
And when they ask me why they did that?
Fees.
Hundreds of millions in fees.
Yeah, she figured the housing market would just keep going up. But then the unexpected happens.
Housing prices go down.
Poor bastard who bought his dream house. The teaser rate on his mortgage runs out. His payments go up. He defaults.
Mortgage-backed securities tank. AIG has to pay off the swaps. All of them. All over the world. At the same time.
AIG can't pay. AIG goes under. Every bank they insure books massive losses on the same day. And then they all go under. It all comes down.
The whole financial system? And what do I say when they ask me why it wasn't regulated?
No one wanted to. We were making too much money.
You'll work on, we were making too much money.
Hard assets don't become popular because people suddenly read more economics textbooks. They become popular because trust has truly evaporated and collapsed. Trust in money, trust in institutions, trust in the promise of a better future by their government, trust that savings and hard work would ever protect you. Every time central banks expand their balance sheets like they're about to do in 2026, every time real rates are held below inflation, just like they are now, every time governments roll debt instead of confronting it, people respond in the exact same way. They exit currency exposure, they reduce duration, they seek scarcity, hard assets. This isn't ideology, it's just self-defense. Hard assets are not a bet on the future. They are a vote against the present system. Because if monetary policy was truly credible, why does everyone always have to hedge against it? Now, this isn't greed, it's balance sheet defense. They'll tell you buying hard assets is speculation, hoarding, excessive risk. That language is deliberate, that language is unambiguous. Because if they admitted the actual truth, that people are fleeing policy, the model itself would be existentially threatened and exposed. Look at the environment, the paradigm, the milieu, however you want to describe it, that we're in right now. Negative real yields, currency debasement, rising fiscal dominance, permanent deficits framed as temporary support. When cash guarantees a real loss, holding it is no longer conservative. It's just reckless. If inflation is 6% and your savings earn 2%, the system is not protecting you, it is liquidating you slowly. Death by 1,000 cuts. Hard assets aren't about upside speculative exposure. They're about survival across changing regimes. When the risk-free rate locks in a loss, what exactly actually is safety nowadays? Every debasement follows the exact same macro narrative arc. Empires never collapse overnight. They stretch their liabilities, they clip their currency, they suppress their yields, they inflate obligations away. Rome, they clipped their coinage. Britain, they inflated post-war debt. The stories are all the same. Different century, exact same mechanics. In every case, nothing ever changes. The currency is debased. The nominal assets always disappoint. Real assets are repriced even higher. Gold doesn't magically outperform out of nowhere. It's because money, the denominator, the fiat denominator in the fraction is underperforming and being diluted. And when money underperforms for long enough, people stop treating it as neutral. Because if debt only survives through repression, why trust the unit actually measuring it? Central bank policy has created that exit ramp. Hard assets didn't suddenly become fashionable. They were forced into fashionability, forced into relevance. Zero interest rate policy, ZERP, QE, quantitative easing, YCC, yield curve control, emergency tools that have never left. Because remember, there is nothing more permanent in the financial markets than a temporary measure. Asset duration always explodes. Price sensitivity increases. Mismatches between liabilities and obligations. Currency credibility eroding. Institutional credibility eroding. The system quietly teaches everyone the same lesson every single time. Don't save. Don't hold the cash. Don't trust that purchasing power. Capital will have to always migrate to non-financial stores of value in this system, in this paradigm. That's not a rebellion. That's rational behavior in an equilibrium system that is actually distorted for its incentive mechanisms. Because if policy punishes savers and rewards risk takers and leverage takers, who adapts the fastest? Now, that's not a question of like Darwinian evolution. It's just a question of pure logic in terms of capital flows. Banks, bailouts, counterparty realities, all of these things aren't isolated to 2008 because 2008 wasn't just a crisis. It was a trust collapse. And we've been learning the mistake of that misguided trust ever since. Banks were insolvent, yes. Deposits were safe only after emergency guarantees. Bailings were quietly written into law after the fire. The lesson wasn't that the system is stable. No, the lesson was that the stability is conditional on the incentives, on the stakeholders. Hard assets don't ever require counterparty risk, solvent counterparties, functioning clearance systems, committee meetings at 2 a.m. with a bunch of intransigent bankers who don't want to save the system but want to profit. There's no duration risk, there's no rollover risk, there's no political discretion anymore. Because why trust a system that only guarantees safety after it fails? You wouldn't buy insurance after your house has burnt down. No one would ever sell you that. Hedge funds are among the parties that read these incentive mechanisms first. Professional capital doesn't listen to the speeches. It doesn't listen to the narrative or the rhetoric. It reads the incentives between the lines. When central banks suppress that volatility, leverage rises, carry trades expand, asset inflation accelerates. Professionals don't argue with that system. They just front run it. They buy the real estate assets early, they hedge the currency debasement early and quietly, and they let the public debate the narratives as if they are completely detached from reality. By the time the households actually are told inflation is persistent and not transitory, the repricing has already happened. Because why do you think professionals hedge inflation while the public is told to, wait and see if things getting better? The saver is never ever meant to win. In this system, savers don't win. This system was not designed to reward prudence and patience. It's designed to fund capital allocation and debt. Savers, slow velocity. Debt requires fast kinetic motion. So policy obviously chooses the debt. That's why cash is mocked, saving is discouraged, consumption is subsidized heavily, because if you don't borrow, you don't participate. If you don't speculate, you fall behind, you don't get exponential returns. Your money never goes over the hurdle rate that is debasement and inflation. Hard assets are what people choose when they refuse to play that game. What does that say about the system when prudence is actually actively punished? Hard assets don't obey that. And hard assets don't obey forward guidance. Hard assets don't respond to press conferences, dot plots, political agendas, narratives, slogans. They respond to scarcity, marginal supply, physical limits. That's why policymakers prefer financial assets. They can be steered, they can be manipulated, they can be supported, they can be repackaged, they can be migrated, they can be rescued. Hard assets can't. They don't care about credibility campaigns. Why would policymakers prefer assets they can intervene in over assets they can't? That's the question you have to ask yourself. And then, upon understanding that logic, everything therein becomes clear. Because inequality is a monetary outcome, just like inflation is a choice. This isn't cultural. It's structural, it's mechanical. Those with assets benefit from balance sheet expansion. They benefit from asset price inflation. And they definitely benefit from currency dilution. But those without assets, the unasseted class, they live on wages, fixed incomes, policy assurances. Inflation isn't neutral. It literally selects and solves for the winners. Hard assets are how the inequality locks in. Because if survival depends on ownership, what happens to those priced out of ownership? They're going to warn you about a few things because they're trying to discourage hard assets. Volatility. They're going to say, oh my God, the volatility cycle, the surface of vol is too unpredictable. The cycles, the economic and the business cycles, too unpredictable to fashion into a portfolio allocation. And the drawdowns, the commodity drawdowns or the hard asset drawdowns are mammoth, are monolithic, are gargantuan. But volatility at least is visible. Debasement is the true silent killer. One scares you briefly, the other erodes you permanently and fatally. Hard assets expose the policy failure. That's why they are taxed heavily, regulated to within an inch of their life, and framed as dangerous, rebellious, fringe thinking. Oh, Luddites for borrowing to buy gold. Oh, look at these people, the barbaric relic of silver. Why is slow guaranteed loss called stability while volatility is called risk? That's the question you should be asking yourself in terms of hard asset allocation. Hard assets are not about optimism. They're about the exit risk. They're about the refusal to hold negative yielding paper, political promises that change on a whim, equivocations, prevarications, mendacity, a lack of veridical veracity, unfunded liabilities that go into the hundreds of billions, trillions even. They are what people choose when belief actually fractures and breaks. This isn't a trade. It's an indictment. It's a verdict. If the system survives by shrinking your purchasing power, why stay loyal to it? History is consistent. When trust in money fades, capital migrates to what cannot be printed. And this time, the migration is no longer theoretical. It's already visible. So what are you going to do? Stay with that rehypothecated imaginary paper or divest into hard assets? Because we're in that cycle, boys and girls. My name is Justin Banton. This is the House of Trade. Ciao for now.